Every day, business is booming and people are moving. And that means the stock market is constantly changing. We can try to keep up with thousands of different companies out there, or we can just invest in ETFs. They just buy a basket of stocks for us, while the fund managers, they do all the work of screening the stocks, and we just watch our money grow. SCHD, or SCHD, is a fan favorite that has proven it can beat the market and also deliver fantastic dividend payments to its investors. There's one other ETF that constantly gets talked about as if it can hang with SCHD. It's called DGRO, DGRO, the iShares Core Dividend Growth ETF. Let's see if DGRO has a place in your portfolio. DGRO is run by BlackRock, so you know your money is always going to be put into ethical and honest investments in nature. DGRO aims to track the returns of the Morningstar US Dividend Growth Index. This is an index that seeks out dividend payments, dividend growth, and long-term equity market returns. Ideal Dividend Growth is a company that can raise its dividend enough to exceed inflation in a given year. In order to pass DGRO screening, a company must have 5 years of uninterrupted dividend growth. This is backed up by the company projecting positive earnings and forecasts from analysts. It must also not pay more than 75% of its earnings out in dividends. Companies that pay more than 75% of its earnings typically have little room to have future increases because most of their earnings are not actually going back into growing their business. It's going out to pay that dividend. I thought this criteria was a little interesting. If a company is yielding in the top 10% of the investment universe, those companies will not be chosen. This is done as a safeguard against dividend cuts and financial distress. Stocks are weighted by market cap and dividend yield. The index membership gets reset once annually in December and gets rebalanced 4 times a year. These are all good criteria any good investor would look at when analyzing and researching stocks on their own. It's pretty amazing we can have the fund do all the work of screening out stocks that no longer may be attractive. For example, we can see in this past year, the companies Intel and 3M were removed from the index. Both of these companies have struggled mightily in the past and now have an extremely high dividend yield. That's actually the reason they were removed from the index. That's extra time the ETF is saving for you by screening out stocks, and you get to spend that time doing whatever you want to do. And it's also taking the emotion out of investing and focusing just on the facts, which is probably one of the hardest parts about investing. How many of you are still bag holding onto your 3M or Intel shares, saying this will be the year management finally turns it around? It's not an actively managed fund, it just follows an index, but it's a way to really automate investing. The fund has 447 holdings. Again, the weight is going to be swayed by how big in market cap the company is and how much in total dollars the company pays out in dividends. The top 10 is dominated by large cap companies like ExxonMobil, Apple, Microsoft, JP Morgan Chase, Johnson & Johnson. These are all really large blue chip companies that also pay out a lot annually in dividends. Hence why their weight is all well over 2%, but a smaller market cap company like the Social Justice Warriors Group, which only has a $2 billion market cap, has a super small weight. Holding the fund means an investor is getting a fantastic basket of stocks and well diversified in their holdings. We can see DGRO gives exposure to the main sectors, which include healthcare, financials, and IT, all around 18% apiece. The other sectors are a little bit smaller, but still getting some ownership in almost all of the sectors. Now, one notable sector that is missing is real estate, which is a shame because there's so many good real estate companies out there that pay so much in dividends, but I think I know the reason why they're not investing in them. You see, just like BlackRock Science Technology, BST, another BlackRock product, DGRO has never paid a capital gains distribution. That means all of its dividends ever have been qualified dividends. Real estate investment trusts don't get qualified dividend treatment, hence that's why they're not included. It's pretty impressive how BlackRock keeps up this impressive tax efficiency streak across its ETFs. How they do this, I'm not sure, but if they sold their soul to the devil, I wouldn't be the least amount surprised. DGRO has a starting yield of just 2.2%, but remember, this is an ETF that is going after dividend growth, so it really has the long-term investor in mind. Over the years, we can see DGRO has raised their distributions, going from 65 cents in 2014 to $1.17 in 2022. DGRO does all this work for us for a ridiculously low expense ratio of just 8 basis points. which is only $8 for every $10,000 invested. $8 is not a lot of money to pay when all the research, buying, and selling is done for us. DGRO's total assets under management has absolutely exploded in the last couple of years. It went from just $3 billion in 2018 all the way to $24 billion at the time of this recording. This means more and more people are trusting DGRO to not only handle their money, but also to grow that wealth. Alright, for the golden question you want answered, is DGRO better than SCHD, SCHD? Well, I can tell you since June of 2014, DGRO has actually slightly lagged behind SCHD, 11.27% versus 11.92%. However, both have slightly outpaced the S&P 500 return of 11.13%. SCHD tracks a totally different index in the Dow Jones US Dividend 100 index and has a slightly lower expense ratio. SCHD also requires a 10-year streak of paying dividends and uses other metrics like cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate in its criteria. Now, one of the biggest criticisms of SCHD is that they only hold 104 different positions, compared to DGRO, which holds 440 plus, but sometimes it is possible to be too diversified. There's a considerable amount of overlap between the two as well. 55% of SCHD's holdings are also found in DGRO, but just 12% of DGRO's holdings are in SCHD. A grand total of 54 different holdings have some overlap. Interestingly, even though SCHD has a 1% higher starting yield, and DGRO stresses the importance of dividend growth, it appears it's actually SCHD that actually has a more impressive record of dividend growth since 2014, when it paid $1.04, more than doubling that by going up to $2.56 a share in 2022. Overall, I think DGRO is an excellent low-cost ETF that offers great diversification, growing dividends. It has really good filters to screen out and get high-quality stocks, get that capital appreciation, and be tax efficient. I don't know if it's necessarily better than SCHD, but it would be really hard for any ETF to dethrone the king that is SCHD. But DGRO definitely has to be among some of the top dividend ETFs out there. I personally own a small position in my Roth. Now, if you want to see my full $120,000 portfolio, check out the Patreon link below. Join the Discord server. We have some great conversations in there. It's a great way to support a small-time YouTuber. Just like hitting that like button and telling me your thoughts about DGRO in the comments below is also a huge help. My videos are always found in podcast form under the Collect Cash podcast name, and I will buy, stash, and collect cash you later.